All right, let's jump right in. For a lot of us, investing can feel, well, super intimidating. It's like this exclusive club with its own language. There's so much noise, so much conflicting advice, it's easy to just freeze up. But that's exactly what we're going to clear up today.
So we're going to assume you've got some of the basics. Like, you know what a stock is, right? It's just a little piece of a company. Simple enough.
And you probably get that the stock market is just the place where those pieces get bought and sold. And yeah, prices go up, prices go down. We're all on the same page there. But here's the thing. That's usually where people get stuck. There's this massive gap between knowing about investing in theory and actually knowing how to put your own hard-earned money to work. So where do you even start? And maybe more importantly, how do you start the right way? So it feels like a smart plan and not just gambling. How do you skip all that hype everyone's talking about? And, how do you avoid losing a bunch of money right out of the gate? That's what we're going to break down. So the very first step, it actually has nothing to do with stocks or the market at all. Nope, it's all about you and your own finances. See, before you even think about building wealth, you got to have a solid foundation to build on. And here's what that foundation looks like. It's a simple checklist. First up, an emergency fund. Do you have one? We're talking 3 to 6 months of living expenses just sitting there. Next, high interest debt. Things like credit cards. Are you carrying any? Because that 20% interest is going to eat up any potential investment gains you make, for sure. And finally, a stable income. You've got to know that the bills are paid and you're secure. This quote just hits the nail on the head. If you're throwing money into the market that you might need for rent next month, you're not investing, you're just speculating. It's a huge risk, right? Because what happens if you need that money and the market is down? You're forced to sell at a loss. So yeah, stability has to come first. It's non-negotiable. Okay, so let's say your foundation is solid. Now we can move on to the second big idea. And this whole thing boils down to one really simple question you have to ask yourself. And that question is, how long are you investing this money for? Is it for something short-term, like a down payment in a few years? Or are we talking long-term, like retirement in 30 years? Because the longer you have, the more powerful you are as an investor. It's because you have time on your side to just ride out all those bumps in the road, the market's ups and downs, without freaking out. Seriously, time is your best friend here. All right, so you're financially stable and you know your time horizon. Now we can finally talk about where to put the money. And this is where so many beginners trip up. They think investing is about finding that one miracle stock, the next big thing. But here's the secret. You really don't. A much smarter way to go is something called diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, that's literally it. Instead of going all in on one company, you spread your money and the risk across a whole bunch of them. And you can really see the two different approaches here. On one hand, you can pick a single stock. That's a huge bet on one company. If it does great, you do great. But if it tanks, well, you could lose everything. The other option is something like an index fund. Think of it as a basket that holds tiny little pieces of hundreds of companies all at once. For a beginner, it's just a way, way safer and more reliable way to start. Okay, so you're diversified. Awesome. The next question that always comes up is, okay, but when's the perfect time to invest? And the answer, well, it's probably not what you think. Just forget about trying to time the market. Seriously. Trying to perfectly predict the lowest point to buy and the highest point to sell, even the top professionals can't do that consistently. It's a losing game. Instead, focus on what you can actually control, which is time in the market. That just means you invest regularly, like clockwork, maybe a little bit every month. Consistency is so much more powerful than trying to be a fortune teller. And that brings us to what might be the single most important part of all this. And honestly, it's the hardest. It has nothing to do with fancy spreadsheets or secret stock tips. It's all about managing the one thing that can totally derail you, your emotions. Look, you are going to see stuff like this. Your investments will go up one year and they'll go down the next. That doesn't mean you messed up. It just means the market is doing what the market does. It's normal. This roller coaster, this volatility, that's just the price of admission for getting long-term growth. You have to expect it. And that is why keeping your cool is so, so critical. Most beginners who lose money don't lose it because they picked a bad investment. They lose it because they react with their emotions. They panic and sell when things look scary, or they get greedy and jump on a bandwagon when things are flying high. How you behave is way more important than what you own. Okay, we've covered what you should do. Now let's quickly run through what you should avoid. Think of these as giant red flags to look out for.
First off, if anyone ever promises you a guaranteed return on an investment, run. Be super skeptical. Stay away from leverage. That's just a fancy word for borrowing money to invest. It can magnify your wins, but it can also magnify your losses in a really bad way. Also, be really careful about getting your investing tips from social media. And this goes back to our first point. Never ever invest money you aren't prepared to lose. If something sounds way too good to be true, it almost always is.
So let's boil it all down. This is your playbook. Number 1, start stable. Get your finances in order first. 2, start simple. You don't need anything complicated. 3, stay consistent. Just keep at it month after month. And 4, control your emotions. Don't let fear or greed be your guide. If you can do these 4 things, you're going to have a fantastic start.
Following these steps gives you a solid, logical way to begin. But it also brings up a pretty big question, right? When we say start simple, what does that actually mean in practice? Should you go with an index fund like we talked about, or is it okay to try picking your own stocks? Well, that's exactly what we're going to dive into next.